Good morning, everyone, and welcome to this ShareSoc webinar with Lowland Investment Company. My name is Vijay Tohani, and I'm a director at ShareSoc, and I will be the host for this event. Today's presenter will be Laura Foll, who is the fund manager at Janus Henderson.
Morning. Thanks very much. And I appreciate everyone who's listening in. I'm going to start. It looked like we had about 50-50 in terms of people who already invest in Lowland, people who don't. So apologies to those who already do, because I might tell you things you already know, but I'm going to start at the beginning. So if we go to the next slide, please. So what is Lowland for the 50% that don't already hold it? It's a UK equity income trust, and it's about 400 million market cap. And the difference of it versus its peer group, or the key difference, is that it invests across sizes of UK companies. So what do I mean by that? I mean that it has about 50% in the largest UK companies, the FTSE 100, but then it also has about 50% roughly in smaller and medium-sized companies in the UK. And in terms of why we do that, because we don't just do that for the sake of it and for the sake of being different, we do that because it gives us a broader investable universe. What do I mean? I mean the chance to find lots of different ideas that you wouldn't necessarily get if you were holding a passive fund, say a FTSE All-Share ETF. So it gives James and I, so I co-run this fund alongside James Henderson, and it gives James and I a broader investable universe to try and find the best ideas, basically. So that's the first point. And then the second point is it's also about diversification. So people think that the US market, or you often hear people talking about the US market being very concentrated in the largest companies. And in the US case, it's tech. Now, the UK market is also pretty concentrated, not in technology, but in different types of large companies. So think from a UK perspective, it's things like HSBC, Shell, BP, Rolls-Royce, etc. So if you want diversification from your UK holdings, you actually need to go down the market cap scale to get that. So that's diversification for both income purposes, so you're not overly reliant on any individual company, but also for capital preservation purposes. So that's why we look across the market cap scale rather than focusing specifically on larger UK companies. We're also an income fund. This trust currently pays a 4% dividend yield if you were to buy the shares today. And we have not cut that annual dividend since the trust was founded. The trust was founded in the early 1960s. We did hold the dividend 1 year during the financial crisis, so you wouldn't see us turn up on the sort of dividend hero list, but we are very focused on income and making that dividend really predictable for our shareholders. So it's a quarterly dividend that we pay, and what we say is it's a quarterly progressive dividend. Again, what that really means is that we will try on a sort of best endeavors basis, outside of a COVID type scenario, to keep that quarterly dividend at least ideally higher than the last one, so that our shareholders who really, I think, really value that predictable income stream will know that that quarterly dividend for them is very reliable. And then finally, we want to use the investment trust structure to the best we can. We think the investment trust structure is a really great vehicle for people, but we need to maximize it in terms of its usefulness. What do I mean? I mean, we use things like gearing. So this trust has a low teens level of gearing at the moment, and that would be fairly typical for this trust. And I'll show in a couple of slides' time that that's been additive to performance over time. It also has a very highly experienced board acting always on behalf of shareholders. If we now flick over, all this shows you is the market cap split of Lowland in the darker green versus the benchmark, which is the FTSE All-Share in the lighter green. And what the slide is getting at is that we are more multi-cap for Lowland. In other words, we have 50% in the FTSE 100, those largest UK companies. The benchmark, the FTSE All-Share, would be more like 90%. So going back to that point around market concentration, the FTSE All-Share, our benchmark, is very concentrated in those largest companies, those HSBCs of the world. And actually, interestingly, that 90% that the FTSE All-Share has in the FTSE 100, which is the top 20 companies in the UK, now make up 60% of the index. So if you're buying a FTSE All-Share, say ETF, the majority of what you're buying is those top 20 companies. Whereas the UK market, I think it takes people by surprise how concentrated the UK market as well as the US market has become. So again, we're diversifying away from that by going more into small and medium-sized companies, and you can see the weight here. If we now flick on to performance, this is to the end of March. The reason this is to the end of March is that Lowland has a September financial year end. So end of March was our sort of 6-month performance. So that's why we struck it here. You might remember that 6 months, at the end of March is when we had the drawdown from, or the sharpest drawdown from the Middle East conflict. So if I sort of bring the numbers more up to date, on a calendar year to date basis, we are now a smidge ahead. So the trust would be up about 7.5% in NAV terms, and the benchmark, just the FTSE share, would be up about 6.2. So we are just a sort of smidge ahead calendar year to date. And in terms of what's driving that, and I realise this is pretty short-term performance now, we have had a couple of takeovers in this trust within the past couple of months. For example, things like Senior, which is an aerospace component supplier, was bid for, and also Schroders, the fund management group, has been bid for as well. So that takeover activity has been ongoing in the portfolio. The other things that have been driving the performance is there's been the UK unfortunately doesn't have a huge amount of sort of data center spend in its market, but sort of just at the edges, we've had a couple of companies that benefit from that huge amount of data center capex that's going on. So what do I mean? I mean things like Hill & Smith, which is mostly a galvanizing company, has a little bit of exposure to that, as with things like Volex, which we hold in the portfolio. So in terms of what's driving that, it is modest. I don't want to sort of overplay it. Outperformance, it has been takeovers, a little bit of help from some good industrial end markets driven by data centers. And then finally, things like Serica Energy, which is roughly 2.5% of the portfolio, which is one of the operators in the North Sea, has really benefited from that rise in energy prices that we've seen since the Middle East conflict. So that's what's driving the, again, very short-term performance. If we look at a more relevant number, which is the 3-year number, and then so over that 3-year period, we're up 50% odd, which is a bit ahead of the market, which is up 45, I'm rounding, up 45%. If we flick on to sort of the drivers of that, because it's been a period where, and I'll show you properly in a couple of slides' time, but for the last few years, being more multi-cap, in other words, investing more in small cap than some of our peers, but also than our benchmark, has been a bit of the wind in our face for Lowland, because small cap has underperformed, and I'll go on to explain why. But what this slide is really trying to get at is, so asset allocation here in blue, the chart in blue just says small cap has been a headwind. That's all that number is getting at. But then the number next to it that says selection is stock selection, and it says basically the wind has been in our face in as much as small and mid cap have underperformed, but stock selection has just managed to eke out enough that we've managed to outperform over a 3-year period. And then it's also been helped by gearing. So that point around, using the investment trust structure to the best we can, gearing has definitely helped. We've done a modest level of share buybacks over this period that's also helped a little bit. And then obviously we've had the fee. So all in, we've managed to outperform in a period where, and perform well on an absolute sense, in a period where we felt that the wind has been a bit in our face in being more of that smaller mid-cap investor than our peer group and our benchmark. So if we now focus a bit on the stock selection point and sort of what's driven that outperformance, which is on the next slide. So this goes into the individual stocks on this 3-year basis. And again, I think 3 years is a more decent period to look at, because the turnover for this trust is quite low. We're talking 20% odd turnover a year in the portfolio. In other words, we hold most positions for roughly 5 years. So definitely we wouldn't be focusing too much on that sort of year-to-date type performance that I was talking about. The 3-year number would be more relevant. So if we focus on it and sort of what's driven that stock selection during that time period, there's a couple of themes that are worth, I think, just drawing out. So the first is takeovers have definitely been ongoing for Lowland. And I know sometimes when it comes to takeovers, obviously each individual takeover is just a one-off and that company is then gone. But what we find for Lowland is that it does have the most takeovers of any of the portfolios that we manage. And if I could just very briefly try and explain why, it's the combination of we are an income fund, but we are also more small and mid-cap focused. We tend to focus in the smaller companies area on a certain type of probably quite established, quite cash generative, smaller business that might be pretty well established, quite conservatively run, possibly a market leader, but in a relatively small niche. So we often focus on the type of company that private equity might also be interested in, or a peer might also be interested in if they wanted a foothold in the UK. So, for example, H&T last year, which is a pawnbroker, got taken over by a US peer at a comfortable premium because they wanted to get a foothold in the UK, and H&T gave them a sort of one-stop shop to do that, quickly and relatively cheaply. So yes, each individual takeover is clearly a one-off, but we find it to be quite a recurring theme for Lowland in terms of what's driving its performance. So in terms of this list here and which ones were takeovers, so things like international personal finance is being taken over, as was Reynolds, which Reynolds was small industrial chains that was taken over last year as well. So takeovers are definitely part of what has driven the outperformance over the past 3 years. And then I'd say the other theme, if I sort of look down the contributors, would be turnarounds. So James and I are quite contrarian. We look for companies where we think the market is being overly pessimistic and things are being missed. So M&S and Babcock have both been corporate turnarounds over the past 3 years, with M&S, which for those listening live, were reported yesterday and reported fairly decent numbers in the face of a cyber attack, a recent cyber attack. M&S under Archie Norman, who's the current chairman, and Stuart, who's the CEO, has really revived its clothing business. If we go back to say 5 years ago, there was a huge amount of skepticism that they could ever turn around that clothing business, but they have done, at least to an extent, successfully. And when you get these types of turnarounds, the really powerful thing from a total return perspective is that you get both the earnings upside and the valuation upside at the same time. And that's what drives that very powerful total return. And it's been exactly the same in the case of Babcock, where there was a new, well, not new anymore, but there was a new CEO and CFO that came in with very relevant experience from Foll, another defense company. And it's quite similar to M&S. They just refocused the business on what it did very well. They reset the balance sheet. They've returned it to growth. And similarly, you got that joint uplift of both the earnings and the valuation, helped in Babcock's case by the fact that the defense spending backdrop more generally has also, for very common sense reasons, materially changed. So they were also helped by the end market. So that's what's driven the relatively modest outperformance, but good absolute performance over the past 3 years. And then if we just briefly touch on the detractors, I'm very happy to take individual questions at the end about any of these, and I want to leave a good amount of time for questions. But if we think about some of these detractors and what's driven it, in quite a few cases, it's really tough end markets. So things like Marshalls, and so Marshalls makes things like paving stones, Ibstock is bricks. The housing market in the UK has been really depressed for a number of years now. While both those companies are market leaders in what they do, it's very hard for them to offset entirely what's been a really challenging end market, particularly for these are quite heavy fixed cost business with pretty substantial operational gearing. So you've had some big earnings downgrades in both those companies. But in both cases, we think we don't know when it will be, but when the cycle does turn for things like house building, we think those companies will be good beneficiaries of that. It's just a case of knowing when that recovery will come, because it's definitely been kicked to the right. Things like Morgan Advanced Materials in the general industrial space have been similarly hit by pretty challenged general industrial end markets in recent years. And things like Vanquis is slightly different. Vanquis has been hit by some regulatory things. It's a consumer lender. It moved away from door-to-door consumer lending. Now it's a more focused credit card business. I think, to be honest, it's probably being better managed now and has more chance of recovery now than it's had in quite a number of years, but it has been hit by sort of regulatory changes over the years. If we flick onto the next slide and think, so that was capital and what's driven sort of total return. If we now turn to dividends specifically, so the dividend over a very long time period, and you can see that the dividend growth has been really quite substantial. That 6.5% CAGR would have been on average above inflation comfortably over that period. But the sort of more eagle-eyed among you will definitely see that in that post-COVID period, so COVID in 2020, the dividend growth have leveled off for a couple of years because we saw really substantial dividend cuts in the UK in that pandemic year that were even more severe at the smaller company end. So we took a big step down in our income from the portfolio at that point, but we grew modestly the trust's dividend. And then it was a case in the following years of the trust sort of growing back into its dividend payment And we're now through that period again. We're now 5-6 years post-pandemic. We've seen most companies return to a more stable footing in terms of the dividend payment. So we're now, I'd like to think of us, you can see that sort of leveling off in the 2020 and around the 2020 years, but we're now back at a better clip in terms of our dividend growth rate. And the latest quarterly dividend was up about 4.5% year on year. So we're now back closer to that historic CAGR in terms of the dividend. The only other thing that I think is worth pointing out on the dividend, I mentioned right at the beginning that it's a 4% dividend yield. That 4% is a true yield, as in we are not distributing out of capital in this trust. That is, you're paying out the income that we get in from the portfolio. And I think that's really important in terms of the sustainability of that dividend, but also sort of maximising our total return. That this is a natural yield from the portfolio, not giving back shareholders' capital. If we then flick on, so that's sort of a bit about Lowland. Maybe just I wanted to give a little bit of background to UK equities as a whole. I'm sure lots of people on the call will be well aware of the UK equity backdrop, but just in case someone isn't, what this chart on the left is getting at is that UK equities are lowly valued versus the rest of the world. So if the chart were to be at 1, it would say that the UK equities were valued the same as equities in the rest of the world. This is obviously a very long-term chart that goes back to the 90s. And what it shows is that UK equities are often about 15% cheap, so 0.85 on this line here, versus the rest of the world. And actually we're doing okay, but then Brexit happens and there's a very steep derating for the UK equity market. And we go to about a 35% discount to the rest of the world, so 0.65 on this line here. And that has been fairly steady, that discount, since Brexit happened. So the challenge I sometimes get from clients is, you say UK equities are cheap. Well, UK equities are always cheap. And to an extent, that's true. UK equities would normally be 15% cheap, but they wouldn't normally be 35% cheap. So there's truth, as often the case, there's truth on both sides, but we wouldn't be quite as cheap normally. And then the other challenge that I often get, which again is very fair, is that the UK market is made up differently. So the UK market has less tech. And again, that's completely fair and true. But even on a sector adjusted basis, the UK market would look lowly valued. So what the chart on the right is telling you, or showing you, is that compared to the US market, every sector in the UK is at, to varying different degrees, but is at a discount to the US market. And what kind of brings it home for me, no two companies are ever exactly the same, but if you look at, say, a Tesco Sainsbury's versus, say, a Walmart Costco in terms of valuation, the differences are really extreme. So things like stocks like Tesco and Sainsbury's, Sainsbury's we on 12, 13 times earnings, Tesco probably on 14, 15 times earnings. If you pull up, say, a Walmart, I was pulling it up yesterday for this presentation, Walmart's on 40 plus times earnings. Costco would be the same. And they're very similar business models, obviously of a different scale. The US market would be of a completely different scale, but similar margins, similar strategies, but very, very different valuations. So you can see retail is at that more extreme end in terms of the valuation discount. And then if we flick to the other end, consumer staples would also be at a discount. So if you compare Unilever to the likes of P&G, Colgate, there would be a discount there as well. If we think about what this chart tries to get at is, well, why is it that UK equities have that valuation discount? And I think a chunk of it is to do with our ownership of UK equities. So this chart says who owns UK equities over, again, a very long time period. And it's badly labelled. The black chunk of it is pension funds and insurance companies. So you can see that in the mid-90s, they own, pretty much half of the market. And then as regulations change and as the makeup, DB schemes change and things, they sell down to have, what now looks like low single-digit % of the market. And the people that come in and buy are overseas holders. So the big green on this, the rest of the world. And what that means is, going back to the Brexit, you can see the derating at the point of Brexit. It means that when something like a Brexit happens, these overseas holders, this green chunk, totally within their rights, go, no, I'm putting a higher political risk premium on this, I'm taking the money out. And it leaves the UK equity market pretty vulnerable to the sentiment of overseas holders without that kind of anchor tenant of a domestic institutional shareholder base. So there's just a fragility to our equity market in terms of the ownership, in terms of what that means for sentiment and valuation levels that other markets wouldn't necessarily have. So things like Australia, countries like Australia, their superannuation funds would be that kind of anchor tenant in their market because they do have that domestic equities overweight that we wouldn't necessarily have. And I think that explains a chunk of that valuation discount that we're seeing. I know that sounds a bit negative. The positive of that is that you can see that the black bit is now a very, very small percent of the overall market. So that selling pressure can't happen again. That's happened. There's only a very small amount left to sell down. But hopefully that explains that part of that de-rating that we've seen in the UK. If we now flick on a bit, the other sort of question mark that I sometimes get from people when they're looking at the UK is, well, does the UK actually have any good companies? Because we haven't had, let's be upfront, we haven't had the equivalent of sort of an Nvidia here, or we have one large cap tech company, which is Sage. We just haven't had that equivalent of that sort of explosive growth in the UK that there has been in the US. The UK, in my view, does have good companies, but it's not always, but often a slightly different type of company than I think leads the US market. So sort of what do I mean? I mean, so both of these companies, Hill & Smith and Cranswick, we own in Lowland. Hill & Smith is sort of galvanizing. In other words, you dip things in zinc to stop them from rusting. Cranswick is pork and poultry processing. So neither of them are glamorous. Obviously, they're very traditional businesses in both cases, but the performance has been absolutely extraordinary and has beaten the S&P over a very long time scale here, 20 years. And in terms of how they've done that, it's not been any individual year that they've had a sort of blowout type result. It's that both of these companies have just kept investing year in, year out, whether it's organically, whether it's inorganically. Something like a Cranswick would be spending over 100 million each year on CapEx, capital expenditure, to just keep that earnings growth going. But it's that compounding effect that has meant that they've managed to achieve that. So it's not explosive growth. I think the UK, for whatever reason, the UK hasn't had that sort of explosive growth. But we do have companies that are, in my view, good, what we would call compounder companies that can just deliver sort of steady growth year in, year out. And that compounds to what are some very good total returns over time. If we then flick on, I think the UK market, I'm sometimes asked what the catalyst could be for the UK market, which I find is probably my most asked question, but I still get it, and I find it surprising that I still get it, because the UK market is up roughly 20% on a 1-year view, and I couldn't tell you what the catalyst for that has been, other than that the UK market got very, very cheap, and is, I think now it's still cheap compared to overseas market, but obviously not as cheap, but it's still contrarian. So what this chart is saying is, this is the Bank of America Fund Manager Survey. Where does everyone have an overweight? Overweight's being in green. Where does everyone have an underweight? Underweight's being the grey. And the UK, despite being still, good performance, 20% in 1 year, is still contrarian. And strangely, that makes me happy, because it means that, it hasn't been sort of overbought. Everyone's not already there. It's still pretty unloved. And I think, to my mind, that means that as people do start to look at it, maybe look over their shoulder and think, oh, it's actually done quite well, maybe I should have a look at it, that it's not reached that over-owned point yet, that it is still quite out of favour. If we then click on sort of what within the UK equity market. So hopefully I've presented a bit of a case for why I think UK equities are still interesting, but there is a subset of UK equities that's performed considerably worse than the UK market as a whole, and that's been small and mid-cap. So all this chart says is, how's the FTSE 100 done? The dark green, that's done very well. It's up sort of 30% over a year and a bit, but mid-cap has really, really underperformed. This was the headwind that I was talking about right at the beginning that Lowland has had in terms of being more small and mid-cap. And you can see a really sharp divergence there in how they performed. And if we look at why, which is the next one, it's because, sorry, it's the next slide. It's because small and mid-cap is so much more domestic. I think it's pretty much as simple as that. The FTSE 100 is a very international overseas benchmark in reality. Things like GSK, GlaxoSmithKline, HSBC. They're not domestic companies. They're listed here, but they're very international. So what this chart is showing you on the left is that the FTSE 100 has only got about a third of its exposure in the UK in sort of domestic PLC, if you want to think of it that way. Whereas when you go down the market cap scale, the 250, the FTSE 250 and below is over 50% exposed to the UK. And again, going back to Brexit, the chart on the right shows you when that divergence happens between the domestic earners that have done badly and the international earners that have done well. So there's been this headwind for mid cap for a number of years. And that, if we flick to the next slide, is the opportunity that I think Lowland can take advantage of in being more multi-cap, because it's meaning that you can get a higher, really unusually, you can now get a higher dividend yield from the FTSE 250 than you can from the FTSE 100. So normally when people think about income, they think about the largest companies because those tend to be more cash generative, more established. But actually, because the FTSE 250 has underperformed so much at the same time as some of those FTSE 100 companies have sometimes cut their dividends, things like Shell cut their dividend during COVID, that actually, if you're looking for income, small and medium-sized companies might be the place to look, really unusually, rather than larger companies. And that's partly valuation, but it is partly because some of those big income payers have cut dividends. And so that's income. And then if you look at valuation, which is the right-hand side, it shows the PE percentiles, and FTSE 250 would be trading considerably lower than its long-run average PE, that would compare to the FTSE 100, which the FTSE 100 is trading roughly in line with its long-run average PE, so neither cheap nor expensive. But it's when you get to small and mid-cap that you get really low valuations versus history. And again, that's an opportunity that Lowland is well placed to exploit, in our view. If we then flick on, I won't go through these, this just goes through the types of takeover premiums that we've seen in the last 12 months or so. But the point it's trying to make is that with small and mid cap, again, sort of going back to the beginning, we are not the only buyers of these assets. So while people, again, I often get this sort of challenge from people of, well, who's looking in small and mid cap, sort of what's the catalyst going to be? Well, we are not, public markets are not the only buyer of these assets. These companies have peers that might be interested. They might have financial buyers, in other words, private equity that might be interested. And all of these have a premium of at least 30%, in some cases 50%, hopefully demonstrating what we think is the scale of undervaluation within the small and mid-cap area, in particular in the UK. We then click on. So turning now to I wanted to throw out a few sort of stock specifics. Obviously, none of these are recommendations, and it's worth saying that Lowland has about 100 holdings, and the way that we run the portfolio is not to take a large level of stock specific risks. So while I'm sort of pointing out these as what I think are interesting opportunities, you have to bear in mind that something like a Marshalls would only be 0.6, 0.7% of Lowland, so just for context. But sort of what areas are sort of drawing my attention at the moment? I think depressed earnings and depressed valuations at the same time, I think, leave a potentially interesting opportunity if you think that those earnings have the chance to recover. So what more in terms of being more specific, if you think about something like a Marshalls, and that picture of a pipe is a Marshalls product that goes into the water industry. Marshalls has had the wind in its face big time in terms of end markets, in terms of house building, in terms of RMI, so repair, maintenance, improvement, and it's meaning that its profitability is very depressed. So you can see here, currently making about 50 million PBT rounding, but on a recovered basis, this is us doing some work, but management also sort of agree that the potential recovered profitability is closer to 90 million. So you could, on a better end market, and like I said, we don't know when this is going to happen, and it probably has been kicked out by the Middle East and interest rate expectations and things. If you could go from 50 million to 90 million and just keep your valuation the same, you're obviously looking at a very interesting total return opportunity there. So those are the types of opportunities that we're looking for in Lowland, and we can be patient for that end market recovery. In the meantime, something like a Marshalls would be paying a 5% plus dividend yield while you wait for those end markets to recover. So depressed earnings and depressed valuations at the same time definitely stand out to us as a potential opportunity at the moment if you're willing to be patient. And then the other area that we think is particularly interesting at the moment, if we sort of flick on, is companies trading at substantial discounts to book, where we think those book values are valid. So commercial property is an area that we've been adding to quite a bit recently. It would be 5-6% of Lowland as a whole. So again, diversity is really important to us, and we're not taking a huge sort of weight in the area, but we are adding something like a Shaftesbury Capital. The reason I put up a picture of Carnaby Street is that Shaftesbury Capital own Carnaby Street. These types of assets, really prime assets in London, are seeing very good levels of rental growth and really low vacancy levels because there's just not much building work happening, not much capacity going up in Lowland, in London. So the types of rental growth is really attractive, but the shares are trading at 30% plus discount to book values. And I've picked Shaftesbury Capital partly because we get to see a nice picture of the West End, but you could equally pick something like a Land Securities, which would be trading at 35% or discount to book value and would be paying a 7% type dividend yield. It's not in favour at the moment, this area, because gilt yields have been going up and that's putting some downward pressure on NAVs. But if you were just to see a stabilisation in, say, gilt yields, or maybe even at some point coming down, then I think attention would turn quite quickly to the level of rental growth that these types of companies are seeing, rather than the discount rate. So that's an area that we've been adding to recently. If we then just quickly flick on to the portfolio, I won't spend time on this. If anyone wants to ask me about any of the individual companies, they're of course welcome. But just to sort of finish up, we think there are opportunities across the market cap scale for UK equities, but particularly in that smaller company area. And that is, we think Lowland is very well placed to take advantage of those opportunities. So with that, and hopefully with the portfolio up, I'm very happy to answer questions.
Great. Thank you very much for that, Laura. That was very informative. Thanks for giving us a good background of the UK market as well as so that was very interesting. No questions have been submitted yet. I've just got a couple of questions of my own. You mentioned that a number of the takeovers had contributed to the fund's recent performance. What is your sense of the M&A activity in the UK at the moment? Is it a case of that all the low-hanging fruit is gone, or is this still a very ripe area for more activity? And as a follow-on question, I mean, surely as the market consolidates and there's not a lot of IPOs happening there, does this not make life harder for you as stock pickers?
Yeah, I think two very good questions. In terms of are we seeing any slowdown in the pace of M&A, I would say no. If anything, it seems to me to be the opposite. So what I didn't mention were things that Lowland doesn't necessarily hold. So things like Intertech in the FTSE 100. We've seen things like Tate and Lyle a bit further down. These are just within the past couple of weeks that we've seen more M&A interest, whether it's from private equity or from something like Tate and Lyle would be a peer. So that seems to be carrying on. And I think you raised a really good point of, is it making life harder in terms of finding new ideas? Because we are having to reinvest. Something like a senior, which we've sold following its proposed takeover that the board have agreed to, was in the portfolio for probably 20 years, something like so, and it was a big holding. So we need to find a home for some of that cash, and it will realistically take time. We're not rushing to reinvest some of that takeover cash because I think that would be a mistake to kind of try and invest it straight away. We need to find those opportunities. We do have a list of interesting ideas, so we're not struggling right now to reinvest that cash. But if we were to carry on seeing this level of takeover activity, it would worry me because we're not seeing the IPO activity. Before the war in Iran, I was starting to get the odd early look type meeting, which was great. But then with the war, that seems to have been kicked out again. So I think anyone who tries to say the UK equity market isn't shrinking isn't looking at the data. It is. So we do need to see some IPOs happening. I'm hopeful that given the UK market has actually done pretty well over the past year, when confidence returns, I think we probably will start to see IPOs, and I really hope we do. Because otherwise, if this trend carries on, we might need to start thinking differently about where we find those ideas. And I think that's just the reality of it.
Great. Thank you very much for that. We do have a couple of questions being posted now. First one is, you have a large portfolio of around 100 stocks. Have you ever modeled it on how Lowland would have performed if you had held a smaller portfolio of your most high conviction positions? Would it have performed better or not?
I think so. No, we haven't modeled it specifically, but I can give you a sense of how it would have done. It would have done worse, and let me explain why. Because our highest conviction, or James and I's highest conviction positions, are often in the small and mid cap area, because that's where we feel we have more of an edge. We spend more time with the companies, they're less well covered by analysts, but small and mid cap. So if we were to have run a shorter list portfolio, we would in all likelihood have held more in small and mid cap. And small and mid cap has been such an underperformer over the past 3 years or so. So in a way, we've been running with a lower conviction portfolio in that we have more in the FTSE 100 than Lowland would have historically had. But in a way, thank God we did, because the FTSE 100, that 50% weight in the FTSE 100 is higher than we would have historically had. But we felt that there's so much uncertainty out there at the moment. First it was COVID, and then it was Ukraine, and now the Middle East, that we felt we need to have more of a weight in that more defensive area of the FTSE 100. And that's, like I said, that's really helped performance. So no, we haven't specifically modeled it, but my sense of it is that we have benefited from having that longer list and specifically more in the FTSE 100 than we would normally.
Great. Thank you for that. Next question. What is your opinion on the prospects of the share price increase in the next 12 months? There's a crystal ball gazing
no,
time.
it's the question that everyone wants to ask, right? And so I completely understand. I mean, see, I can't give guidance, but let me give you some context. So the discount for Lowland has widened a little bit with the war happening. We'd got the discount to NAV. Well, not we, the discount of the trust at NAV had got into about 5% before the war happened. It then gapped out again because I understand confidence and things like that. And so it gapped out to about 10%. Now it's about 9%. That would be slightly on the wider side of its long run average. So that would give you a sense of where the discount is compared to its history. The portfolio PE, so price to earnings, is on about 12.5 times its 12-month historic earnings. And I think it's important that it's on the 12-month historic because, like I said, there is a lot of uncertainty at the moment around energy prices, around how the consumer is going to react. So 12.5 times historic would also be towards, well, slightly lower than its historic average. So hopefully that gives you a sense of, again, we can't make any promises or anything like that, but the discount's a little bit wider, the valuation is still a little bit lower than where it's been historically.
If I may just ask a question on that. As managers, you appear to be doing everything right. I mean, you've got good stock selection, good stock picking. You've got a long dividend track record. Your gearing has enhanced returns, and where possible, you've been buying back at discounts. And yet, there's still a discount to the NAV. Now, is that something? Is that something? Is it a permanent feature, or do you see? I mean, what else can you do basically to reduce that?
I mean, to an extent, let me try and think about how to explain. So Lowland, because it's got small and mid cap, it sits within the UK income sector because it is an income trust and it pays a 4% yield. So that's the right place for it to sit, definitely. But because it has small and mid cap in it, some of those assets are more liquid. And therefore it trades a little bit like it's in the smaller company sector, almost like a hybrid between the UK equity income sector and the smaller company sector. And the smaller company sector do, because of that illiquidity, do tend to trade at more of a discount because people know rightly that if you were to liquidate the whole portfolio today, there would be a hit that you'd have to take. So there isn't, you say kind of, is that permanent? Well, there is a slight structural element of it, of being more in some of those more liquid assets, but
Right.
that's it's an advantage in that you can take advantage of some of those smaller company valuations where if you were running, say, an open-ended equivalent, it would be much harder to go down. You've got liquidity with funds coming in and out every day. It would be harder to go down the market cap scale to where we think some of the biggest valuation dislocations are. Do you see what I mean? So there's always a bit of a quid pro quo. So there might be a little bit of a structural element.
Structural. Okay. Great.
I think the other element, that being said, the discount did come into five-ish before the war. So it didn't get to par. I think there is a bit of a structural thing. Didn't get to par, but with sentiment towards UK getting a bit better, the discount did come in a bit.
Right.
So yeah, hopefully that gives you a
Great.
balanced answer.
Indeed. Thank you. Thank you. We have got another couple of questions. What is the reserves level at in pence for the dividend?
The revenue reserve is pretty modest, to be honest. It would be a couple of million, but be a bit careful with what I would say is be a bit careful with revenue reserves. People talk a lot about them. The ability to smooth a dividend is definitely helpful for the industry, for the investment trust industry. I mean, revenue reserves are not a pot of cash sat somewhere to be distributed. So to an extent, the revenue reserve and the capital reserves are one and the same.
Wise words, indeed. And we have one more question. Within the housing sector, are you holding back from adding to positions until the landscape or signs improve, or are you happy to hold what you have?
It's a very good question, and it's one for active debate because obviously the house building industry, we didn't think it would be this weak for this long. And we were hopeful that this would be the year before the war happened. We were hopeful that this would be the year that interest rates would come down, probably more than they are going to now, and that actually activity would pick up a bit. So how have we kind of dealt with that? We own more in building materials than we do in house building. Our house building weight is pretty limited. We have one Scottish house builder called Springfield Properties, which, to be honest, is a slightly different proposition, serving the north of Scotland. And then we have a small position in Bellway, but we have bigger holdings in the likes of Ibstock, Marshalls, and other sort of smaller like Ali Mass and building materials type companies. So the thinking behind that is that volumes, we definitely need to build more houses to serve the population that we have. So the volumes will at some stage need to recover. And when we don't know when, but when they do recover, the operational gearing, in other words, the drop through from sales to earnings, when that top line does pick up for the Marshalls, the Ibstocks of the world, we think will mean a substantial earnings uplift to come at some point in the future. That because it's been now so long since there's been a good end market for those companies, that the ratings have reached low levels on those depressed earnings. And whenever I talk to anyone about something like a Marshalls, which used to be a very well-loved, more mid-cap stock, they're shocked when I tell them that the Marshalls market cap now is almost 300 million, as in it's gone so far down the other way. We think its balance sheet is okay, so we're not looking at, equity dilution and that kind of thing. We don't think it's that bad. So we think we stick with them here. So we're adding a little bit, we're not adding in size, but we think we hold on to the names where we don't think this is a structural problem. We think this is a cyclical one. And that when we get out the other side, we think we'll see a substantial earnings uplift.
Great. Thank you very much for that. Laura, we don't have any other questions submitted, but if I may indulge just one more question from me. I was interested to hear, you said that you have about 100 holdings and a turnover of about 20%. I'm kind of intrigued about your sell discipline. Now, you mentioned a couple of compounders, Hill and Smith and Cranswick, which have gone up over 1,000%. What would make your decision to exit those stocks? Is it when they reach a certain size? Do you have a target price, or what is it that determines you get them out?
It tends to be valuation. So
Right.
something like a Cranswick, which is now trading on 17, 18 times type earnings, we are having an active debate about a holding like that because most of its peers in the food production sector would be trading substantially below that in terms of valuation. So yes, it's a really good quality company. It's compounding for all the maybe the reasons I explained, but we are not the only ones that have noticed that, and it has re-rated as a result. So I think it's mine and James's job to try and find the next Cranswick, to recognize that, we're not alone in finding Cranswick now. We need to find what's probably going to be a smaller company that's slightly less off the radar that can be the Cranswick of the future. Because hopefully Cranswick can carry on, and I really hope it does and carries on being successful. But the rating is a bit higher now, so we need to probably look a bit further down the market cap scale and find the next one.
Brilliant. Thank you so much. Thank you for a really interesting and informative presentation. And thanks for your very candid answering of your questions. Thank you.